This is our Forex blog for June 8th, 2012, and I'm going to quickly go over our Forex rules. We have an easy 3-step Forex system for new traders, and you can watch all of our educational videos to add more advanced things like position sizing, money management, analyzing what the risk versus reward is per trade, fibs, support resistance, and about 20 different topics. For new traders, the first step is to use a currency meter or hot list to find the strongest currencies to buy and the weakest ones to sell. With a currency meter, you want to buy the strongest one versus the weakest and sell the weakest versus strong. Step 2, wait. Too many traders are impatient. You need patience and discipline. You might be lucky and sit down and find a trade within 5 minutes, and other times you might have to wait half an hour, even an hour to find a good trade, one that's likely to give you 20 pips, for instance, if you're risking 8 to 10. That's a good trade. You buy the strongest currencies from step 1 when the buy signal shows up and price goes 1 pip over the previous bar's high. Or if you're a little bit more conservative, you want to eliminate some of the losing trades, have a higher winning percentage, wait for the trailing stop to get hit, and flip down below price and then turn green, then buy. You want to sell the weakest currencies when the sell signal shows up and price goes 1 pip below the previous bar's low. Or you can wait for the trailing stop to get hit and flip up above price and then turn red, then sell. So for exits, inexperienced traders or those with small accounts under 50,000, 25,000 should use trailing stops for all of your exits. Professional traders and or those with larger accounts should exit half the trade using these rules. If price stalls at the next support or resistance area, exit half your position. This could be a Fibonacci profit target, Fibonacci retracement level. I have all the key levels of support resistance here in order that I find them from highest significance to lowest. And then you would exit the remaining part of your trade at or below, above or below the 1.618 fib target or the trailing stop. So in other words, if you buy and it goes up and it hits the previous month's high, which is maybe 20 pips above where you bought it, and it's stalling, exit half. If it comes up to the 1.618 fib target of the previous swing, you would probably want to exit there. Or if you want, if the trailing stop's just a few pips below and you think it's going to go further, then wait for the trailing stop. Sometimes you'll get another 20 pips. But most of the time, the 1.618 is the maximum profit. Markets rarely ever go beyond the 2.0 fib level. So if it hits the 2.0 fib level, you might hold on for another 5 or 10 pips, but that's about all you're going to get. If it goes above the 2.0 fib level, watch for any sign of it reversing. If it's going up and you see a red bar on the range chart, get out if it goes 1 pip below that bar's low. Sometimes they go above there, but 80–90% of the time they do not go above the 2.0 fib level. And it depends on how big the swing is. If you draw fibs on 15 pip swings, then the 2.0 fib level is basically 100% of what that first swing is, which is 15 pips. So that is insignificant. If you draw a fib on a 40 pip swing, it's much more valid. So here is the currency meter. We're going to sort it from strongest to weakest. This is our new sortable currency meter. The New Zealand, Australian, and yen are the strongest, then the dollar, and the Swiss, euro, and pound are the weakest. Now, most of these charts are live-only results. It's impossible to do some of what we do historically. You bring it up and you leave it running. I leave this running pretty much all week, so I have it live results all week. The euro and pound are the weakest of the ones that most of us trade. Right now, the yen and also the dollar were strong earlier. You can also sort this in the order field I have here. So you can see that the dollar had a brief amount of strength earlier, but it's been weak for a couple hours now. It's gone strong again. The yen was incredibly strong earlier. So basically you would, last night in trading, the euro is one of the weakest, the yen's the strongest. Let's scroll back and look at the pound. The pound was moderately weak at 230. Previously, you can clearly see the euro is much weaker than the pound. So you want to sell the euro yen. Let's bring up the chart. Let's scroll back and look for trades. You're looking for sell trades. Now, last night the first entry was right here. It went down. This is a 5 pips per bar chart. If you really believe in the trade working, you can always draw your fibs off the previous move and exit near the fib targets. Oops, hold on a second. you can see it really did not go below the 1.618, and that's why I have that rule. On this pullback, there's another trade. I would draw my fib. The bigger the swing, the better. The more likely the fib targets are going to be significant. All right, so you can see it came down and it stalled again at the 1.618. In this case, it did go a little bit further. Notice the 2.0 level. And this is why I always tell you, don't be greedy. Get out at the 2.0. It's usually the end of the move, you know, and if you get out at the 2.0 level, you're going to probably catch the majority of pips most of the time. Then you got a pullback trade right here. These are some counter trend signals, which are also pretty big warnings. Very rarely when the market goes below the 3.0 green band does it continue. You can see a nice reversal. If you missed the trend trade down, and there's a lot of more trades on here that don't show up as patterns. One of them is a rectangle pattern right here, which we've been teaching for the last 6 years. Anytime you have a 30 minutes to 2 hours rectangle pattern, that trend's very nice. You can see this is incredibly weak right here, so any kind of pullback trade is usually good. I don't like to personally sell them when they're underneath the white band. I'll wait for it to go down and do a counter trend trade. You know, buying this thing right here at 89, I would have probably got out here at 01. I'd trade a lot of lots. I would have shorted here. Probably might have flipped here, but maybe not take this trade because it wasn't down here. When it came back down again with less weakness, I would have probably got in here and got out with a few small pips. And usually what I prefer to do with counter trend is draw my fibs on this, and I will much more aggressively look to buy down here at this level. I would have probably got in this around 66. It went up and went sideways at 78. You know, it's only 12 pip profit, but with big lots, that's a lot. So the euro was weak, the yen was strong. Another one that was extremely strong last night was in New Zealand. I don't leave the pound New Zealand or euro New Zealand charts running, but we can also see that the dollar was quite weak from 7. Strong New Zealand, weak dollar, so we're looking to buy the New Zealand dollar. Bring up the chart. And when this is underneath the hourly moving average, we're basically looking for sells. When it's above the hourly, we're looking for buys. When this one took off after 7, it really was underneath and it was trending down at the time. So, you know, there's no signals on here. You might want to buy it when it breaks out from below to above the hourly right here. And this is a counter trend signal, mainly because the daily trend's down still at that point. If it hits the previous day's low coming from underneath it and it stalls and reverses after a 4 or 5 bar pullback up, usually that's going to start a new trend down. Today it didn't. So there really wasn't any buy signals on this one today, unfortunately. But it wasn't that much of a trend. If you traded the super weak euro versus the New Zealand by selling it, let me bring up a chart real quick and show you that, or the pound New Zealand, you more than likely would have had much bigger moves. Let's put a 6 pips per bar chart on here, put on layer 3 that I have visible. Scroll this chart over, make it bigger. So the euro was super weak, the New Zealand was very strong, and if you add the FX trade signals to it, you could be looking for trades on this. And this spots some of the trades that we recommend and teach based on chart patterns, but it doesn't find all of them. Some of them are very hard to teach a computer to do. Here it is, FX trade signals. Does a lot of calculations before showing up. And so once you're looking for counter trend trades, you can kind of spot these signals right here. You know, let's look at when the New Zealand was really strong. It wasn't really strong until about 3, and a little bit of pullback, 430, in brief amounts since then. The euro was pretty much weak all day till about 7, and then 8:30 again. So basically, you're looking for sells. The bigger the pullback, like this, the higher the odds you're going to make money on it. I don't like to take trades with not much of a pullback here, here, or here. But if I see some, a bunch of sell signals and the market does not go down, nor does it go up, and this is a perfect example of a multi-hour rectangle pattern that we've used for the last 6 years. If I see multiple sell signals in a range pattern combined, I will sell it when it breaks the low, especially if it hits the low, comes back up, doesn't go back to the high of the range, and then breaks down. That's a very high probability pattern. You want to draw your fibs off the last wave. The bigger the better, from here all the way down to the bottom right here. And again, the 1.618 usually is the maximum profit. If it stalls at the 1.382 right here, I will get out of half and let my trailing stop get out of the second half. When it goes below there, usually the first sign of it going back up, I'm usually out somewhere around here, because I know I could hold on and make another 5, 10, maybe even 15 pips. But if I have a nice, 25, 35 pip profit, I'm not going to risk giving 10 pips of it back. Giving back 1/3 of your profit potentially just to make another 10 pips doesn't make sense. I'd rather get out, go look back at the charts for other trade opportunities.